Hey everyone, welcome to the channel if you're new. Today we're going to be looking at some more earnings, this time from American Express, which released their earnings before the market. And the stock has reacted negatively, down 1.82%. But during the beginning of the trade, it was actually down a lot more. It was at $1.154, which was down over 5%. So it has recovered at the time of recording right now. So let's have a look at these earnings and see if it's a buy. This is a company that I've wanted to get into as it is one of Warren Buffett's biggest holdings, and it has done very well over the past 10 years, up around 138%. And if you look even further than that, it's gone on a huge rally from $8 to where it's trading at now. But of course, past performance cannot be used to determine future performance because things are going to be changing within the company. And that's why it's important to keep up to date with what's going on. And hopefully this video helps people out. I haven't uploaded in the past couple of weeks, so sorry for that. I was actually on vacation and I had also some work that I had to do, but now I'm back and I want to make a lot more YouTube videos. So if you don't want to miss out on anything, be sure to subscribe to my channel and let's get right into the video. Getting into the earnings estimates for this company, we can see that from an earnings per share perspective, they're actually expected to decrease down 2% this quarter, but over time, it is expected to accelerate again in the double digits. And from a revenue perspective, it is also in the double digits up until 2024, where afterwards is expected to go into the single digits, but still in the high single digits. There aren't that many analysts covering it that far in 2025, especially there's only one analyst. So that's so far away that it is a little bit hard to predict, especially how the revenue is going to be doing at that time. So that is something to keep in mind. But this company is growing very rapidly, at least for the next 2 years, where it's at the double digits. So that is very good to see. When we compare American Express to their major competitors, Visa and MasterCard, we can see in the past year, American Express has not been keeping up with those two companies, where it has been going down around 13.5% in the past year, whereas Visa and MasterCard are actually up 7% and 2.44%. And even in the past 5 years, American Express has had the lowest return at 60% when you compare it to Visa and MasterCard. So hopefully American Express can do a catch-up trade. One of these indicators why I think American Express is not doing as well as Visa and MasterCard is because American Express does also sell loans. And right now, with the recent bank runs that have happened in the financial markets, people are a little bit more hesitant to buy American Express, which I think is a reason for why the price returns of this company hasn't been as high as Visa and MasterCard. Even though when we look at it from like a PE perspective for Visa and MasterCard, American Express is lower than those two, but it is also not accepted in as many places. So that's also another reason that could be why American Express is not doing as well as Visa or MasterCard. But if you're a value investor, that could be a reason to get into American Express just because it does have a low valuation and it is growing pretty rapidly as well. One thing that is very important to keep track of is the customer credit loan write-off rates. So this is very important for any bank, and especially with the recent hesitation that people have with banks to see how well they are handling a potential recession. We can see that actually right now, even though it has gone up from Q3 to Q4, where the loans write-off rates has gone up very slightly, 0.3%. Pre-pandemic in Q4 of 2019, actually 2.3% of customer loans were actually write-offs. So that's the same with member loans that have 30 plus days past due. It's still very small increase where it's going from 0.7 to 1% in Q4 2022. And pre-pandemic, they were at 1.5%. So all of these rates are lower than what was expected in the pandemic. So that's something to keep in mind when we look into American Express. Some other recent news about American Express, we see that they are going to be buying back 120 million shares. They announced this a couple weeks ago. So I did do the calculation on this, and this is amounting to around 16% of the shares. And they're also doing a dividend increase by 15%. So this is very good to see as a shareholder, as you are going to be getting more ownership in the company. and a higher dividend to hold the stock. Getting into the actual earnings, we can see that they did miss on their earnings per share by 27 cents, but the revenue was beating the expectations by $260 million. So we'll get into why the earnings per share is decreasing when we get into the earnings report. But mainly, this is because of the additional credit losses that they're doing, because they are somewhat anticipating that there might be a recession and they do want to have some money ready in case there are more write offs. So they are still reaffirming their full year revenue and earnings per share guidance. So that's very good to see because this company is still going to be growing a lot. Now, getting into the earnings report, we can see that the volume of transactions has gone up 14% year over year. The revenues that are net of the interest expense has also gone up huge, 22%. But the provisions for credit losses has gone up. So in the previous year, they were actually releasing money from their provision for the losses. But now that there is a potential for a recession, they are adding extra money, around $1 billion more. So this is causing their net income to go down to $1.8 billion, which is down 13%, and the earnings per share to also decrease. But we do see that the common shares outstanding has gone down. So they are doing many buybacks, which is one of the benefits of holding American Express. So it's gone down 2% year over year. We also see in their earnings report that they had acquired 3.4 million new cards during the quarter. And they say most of this demand is coming from millennial and Gen Z consumers. So they are accounting for 60% of all new consumer account acquisitions in the quarter. So that is a very huge cohort and it should get bigger over time. So hopefully they're able to acquire even more of the younger generation, as this will have fueling a lot more growth for this company. And we can also see that these millennial and Gen Z customers are spending a lot more money as well, which is growing 28% from a year earlier. So whatever people are talking about a weaker consumer, it seems like the younger generation is not really worried about that and still increasing their spending. Getting into the earnings statement, we can see that from a year over year, the non-interest revenues has increased substantially for 18% from 9.5 billion to 11.3 billion. But when we look at the interest income, it has gone up a lot higher, 75%. So from 2.5 billion to 4.4 billion. So American Express does sell loans, as I had mentioned before, and they are benefiting greatly from these higher interest rates. So this should be a tailwind over time though, because I do anticipate that the interest rates will start going down as there is a possibility for a recession coming up soon. But this is helping American Express in the short term, but they are also able to acquire a lot of customers. So I wouldn't really worry about it too much. So when we look at the combined expenses, so there are expenses that are coming from the interest expense. This has gone up also 22%. So, but it's still a lot higher than the 75% increase that they're getting. And when we add everything together, we can see that the total revenues after provisions for credit losses has increased 12% year over year. And when we look at the provisions for credit losses, we can see that it has gone up substantially year over year. So from 80 million to 222 million that they've added. And then there was actually a decrease for loans because at that time, it was during the pandemic, they weren't anticipating people to have a recession at that time. So there was a decrease of 111 million, but now they're adding 786 million as a provision for credit loss. And then for others, also 47 million. So it has gone up huge from a decrease of 33 million to an increase of 1 billion in provision for credit losses. And this is decreasing their total revenues. And when we get into the expenses as well, we have seen that those have gone up huge, 22% year over year. And basically everything is up across the board. So card member rewards has gone up 21%. So they are adding a lot more perks for members. And then the business development has gone up. The card member services has gone up 57%, marketing up 10%, salaries up 22%. The only thing that has decreased is their professional services, so hiring expensive consultants, but everything else has gone up. So this is not a good sign for this company that all these expenses are going up. It does indicate to me that they might also be having some competition with Visa and MasterCard, and in order to get new customers, are having to spend more. So hopefully they are able to cut down on some of these costs. Now, getting into the balance sheet, there isn't really too much to worry about here. The total assets has gone up 20% from 196 billion to 236 billion, but the total liabilities has also gone up 21%. So it has basically increased a little bit more than the assets, but not really too much to worry about here. They still have a lot more assets than liabilities. We can also see that they are mentioning the shares outstanding. So quarter over quarter, it hasn't really changed at all because they did do a repurchase of 1 million shares, but they also had some employee benefit plans, which have increased 1 million in shares. So it's basically flat quarter over quarter. But year over year, we do see the decrease from 755 million to 743 million. And we don't have yet the full effect of that buyback. And once they do buy back more shares, it is going to decrease in the future. So that is very good for investors. Now, getting into the technicals for American Express, it had peaked at around 2022 February, where it had gone to $195. And this is a company I like to keep track of. It had been in a downtrend up until the end of 2022 in January, where they did announce their earnings. And what happened was that this stock had gone up huge during the earnings. And basically right now it is just trading sideways. So if you do like this company and you want to hold it as a long-term investors for multiple years, kind of like Warren Buffett, I wouldn't blame you for buying this company at this time. I had bought a couple shares of this company. I do think that from a long-term perspective, it is a very good company as it is doing many buybacks, increasing their dividend, and also growing very strongly. So this is one of my companies that I very much like as part of my dividend growth portfolio. So that's basically my analysis on the company. I do think that one of the potential issues that this company could have is if they can't manage their costs effectively. If there's a couple more quarters like this where all the expenses keep increasing, it could be bad for this company, as that's not something that can be held up long term. But this company has been around for many years and they have a very good management team. And as of this moment, I'm not really worried about that too much, but it is something to keep in mind about this company. So if you like this video, like the video and subscribe for more videos in the future. Thank you.